let's go to our next panel, Global Portfolio Allocation. And to moderate this panel, I would like to invite to the stage my friend and colleague, Laura Seabra, Head of Digital Channels of TPD and BTG Pactual, along with Matthew Cole, Portfolio Manager for Rowe Price, and Luis Ferreira, Head of Strategic Investments from EFG. Please, guys, good debate for everyone, please.
So, thank you all for being here today. It's a pleasure to moderate this panel. Today we welcome Matthew Cole, Portfolio Manager at Rowe Price, and Luis Ferreira, Head of Strategic Investment at EFG, to talk about global asset allocation. Before we jump into questions, I will kindly ask you to present yourselves. Luis.
Absolutely. First of all, thank you very much all for being here. Super happy to see. Congratulations on the event. Looks great. So I'm Luis Ferreira. I'm based in Miami. I'm the head of investment strategy group there. And my goal is pretty much to understand all opportunities that is available in the market worldwide, understand the client needs from a risk perspective, from cash flow perspective, and then build the portfolio. And that's what we're trying to do here to talk about asset allocation. Should we do more fixed income or more equity today? Should we be long duration or short duration? Should we go more value or should we consider growth? Things of this nature, which is very important, especially in a world that is changing very fast, and especially now that there are tremendous opportunities available for those who want to diversify. So I think we're going to have a nice chat here.
Thank you all for having me. So I'm Matt Coe. I'm at T. Rowe Price. I work on the multi-asset team at T. Rowe Price. T. Rowe, as a firm, manages about $1.3 trillion in assets. Multi-asset investing is about $450 billion of that AUM. Within the multi-asset team, I work very closely on the Global Allocation Fund. So within Global Allocation Fund, we leverage our research platform to be invested everywhere across the globe in global equities, global fixed income, as well as using alternatives. And then we also make tactical decisions on a month-to-month basis, based on where we see quantitative signals, market signals, macroeconomic data, as well as fundamental data from our research platform to make decisions on where the opportunities are and moving the portfolio in those areas of opportunity. So I'm going to share what some of those recent tactical decisions are, and some of the comments I have to share may be more the current debates that we have within our team. Not an actual decision, but perhaps an unwinding of a past decision and why we are looking to make potential changes in the future.
Thank you. So we're seeing the economic and market data are indicating a recession in US. But equity market seems to be resilient and not reacting. What do you attribute this to?
Well, if I can start, when you think about the US recession, for this cycle in particular, this is the most predictable recession of all times. And there's a way to measure that. The central bank, they do have this survey showing the possibility of a recession, and it's even higher than all of the previous recessions in the United States. So by that, it shouldn't be a surprise for financial markets to have a recession now, because we're just getting back to normality. What does that mean? Well, back into COVID, we did 2, 3 Marshall plans in the United States. We printed 3 more times money than we've done in 2008, so it's very normal now to get back to normality. So that's not scaring us, and that's not scaring the market overall, and I think that's a good sign. And we've done some research on that, showing, tell me where is the unemployment rate when it's going up, and tell me what happens to the S&P. And what we found was, actually, there's no much correlation on looking to unemployment rate and the S&P. And remember, guys, the financial markets, it's completely different than the real economy. We're talking about in the S&P 500 companies, right? So that's number one. And number two, looking to the other side of the equation is overall markets, actually, if you put an equal weight on the S&P, so we're taking over the Meta, the NVIDIA, the Apple, and everything, actually the market is flat. So what I think is the bottom line is the recession will happen, but now that we have such a low unemployment rate, I think their interpretation should be the following. On the real economy, Nobody's going to start laying off people just because of expectation of a recession. What they might do is, okay, let me take care of my inventory. Maybe I'm going to lower that a little. Maybe I'm not going to expand much. I'm not going to have a lot of debt. But I'm not going to get in the way of my talents. And that's why we're going to be a recession, in our point of view, that's going to be shallow, and it's not going to be long. In our best case today, the contraction starts now in Q3. And then we're going to have another contraction in Q4. We estimate approximately 0.5%. And if that's the case, we understand that we shouldn't be concerned about global investments, because this is the end of a cycle of the monetary policy. It is likely to be the end of cycle of the economic activity. And going forward for the next 18, 24, 36 months, I think the United States will come back stronger, with less debt, less leverage, and overall with more opportunities.
So what's going on in the U.S. and why is the stock market resilient in the face of declining macroeconomic data? This is something we talk about nearly every week within our strategy teams at our firm. What is going on in the marketplace? How are investors and how is sentiment so positive in the face of declining manufacturing data? And a number of other signals like an inverted yield curve that have historically foretold a recession. When we look at the data, the macro data is quite negative. Looking at about 80 known economic indicators, they would all say, if I were to use a stoplight analogy, red light, right, stop, yellow light, sort of slow down, green light, go, everything is sort of screening as a red light. The recession is coming. That being said, we are in a very unique cycle. What happened during COVID was truly unique from the standpoint of not just 3 Marshall Plans in terms of stimulus, but if you think of what happened in the economy in 2020, there was a sudden stop to the economy. People weren't allowed to travel or take part in services activities, and so the only thing that individuals were able to spend money on were goods. And so manufacturing activities surged to record levels. And then we had the vaccine in 2021, and then over the last couple of years, you see this switch and slowdown in manufacturing and a resurgence in travel activity and other services-related businesses doing well. So perhaps there's some distortions going on with all these macroeconomic signals that have historically foretold a recession, but maybe this time there's just a little bit more confusion or maybe less signaling power around what it means. You can't go from an economy that goes sudden stop to sudden acceleration with only manufacturing to then pivoting to services and saying those signals have the exact same power or same relationships as they would have had in the past. The other thing that we see here in the United States that's quite different is consumers and corporates have much more cash on their balance sheets relative to the last 20 years, relative to any point in the last 20 years. It's quite an interesting phenomenon that what we see is post-global financial crisis, there was a massive deleveraging that we saw across both consumer balance sheets as well as corporate balance sheets. So today, the average US consumer has much more cash relative to their debts and higher net worth balances relative to any point, and certainly in the last decade, if not the last 2 decades. And so perhaps that gives the consumers, that gives corporations who haven't really overspent, over-leveraged going into a slowdown, maybe more runway for growth. Maybe the sting of higher inflation and higher interest rates don't necessarily slow down the economy immediately, but over time. So I do agree that maybe if we do have a recession, it's going to be more short and shallow rather than more of a severe recession. Perhaps there's still a small chance, albeit a very small chance, that we're able to escape a recession and we'll be able to just kind of slow the economy and then start to reaccelerate in the second half of this year. The positive catalyst that I don't think anyone has foreseen is this AI boom. You're seeing corporations talking about artificial intelligence and spending billions and billions of dollars capital expenditures to try and build a supercomputer and building apps on top of that to win the race to AI. This is truly unique in a slowdown that we're seeing this massive influx of capital and investment spending, and that has the potential to allow for that sort of no recession scenario to actually take place.
How do you address increasing rates and how this affects the correlation between equities and bonds? And what about alternatives?
Yeah, I mean, let me ask you a question here, and if you can, guys, just raise your hands. Who believe interest rate is going up in the United States for the next meeting? I can easily say here that's not a consensus in this room, right? And who believe now that investing in US treasuries, making 5% per year for the next 12 months, is going to be the best investment? So, far from consensus, right? But this is what is priced on the yield curve right now. The yield curve is priced in 25 basis points. But let me tell you something about the yield curve. Get back 30 days ago, or 45 days ago, it was pricing 3 cuts of interest rates. Get back, at the beginning of the year and look what they call the dot plot. It is, every person that decides about the monetary policy, they tell what the expectation of interest rates. That's a massive change that these guys are doing. So rather than try to predict what's going to happen, I have no idea what's going to happen. But I know what is my target for asset allocation. How much do you expect, for example, to make in terms of returns going forward? If your answer to me is 5%, why bother? Just buy a treasury. But if you're looking for the next 24 months, 36, etc., then the game starts to get very interesting overall. So when you ask about the correlation, that's true. Usually there is a different correlation between equities and treasuries because when everything goes wrong in the equity market, everybody runs into the treasury. It's safety, right? And that's what happened, lately. But interest rate went up at this time. That's why the correlation was gone, because on the market-to-market basis, you lost money when you were investing in treasuries as well. Does that mean this correlation is gone? Absolutely not. We actually feel that the correlation will going to get back to normality. And already answering, the questions that several clients are asking, it is the, multi-asset portfolios now dead? No. This was, a very unique cycle. I think somebody said one day about what happened to COVID, which was a Bible event, meaning it was something that happened every, 200, 300 years. Nobody could predict that. That doesn't mean that 1 or 2 years of underperformance would be bad, but for those who are looking for long term would be a great opportunity. And that comes also alternatives. Usually alternatives has a lower correlation with the other portfolios, and to be honest, it's because they don't do market to market. Show me daily prices of an apartment and you see, how volatile that could be, depending on the mood of the person who is showing, depending if the painting of the wall is good or not. So alternatives plays a very important role in the investments from a risk-adjusted basis. But I suspect there is something to do to the fact that there's not big market to market. So going forward now with the super high interest rates, it's likely that we're going to start seeing some negatives NAVs of alternative investments now. To conclude on that, now going back to interest rates, and I think I'm going to give you guys here a non-consensus call, and I hope that adds value to you. Number one, if you think of a Federal Reserve, or it's the institution that can hire the best economists worldwide, that can purchase the best softwares of making predictions, and can hire anybody to predict, and they made that wrong. However, what I can tell you now, regardless the prediction is, inflation's expectations are way lower today than they were in the past. So I don't see any company or any investor expecting 5 or 6% inflation for the next 12 to 24 months. That's number one. So I think it's well anchored. Number two, it's not expectation that inflation is going down. The peak was 9 and we are at 4. So it is going down already. And when you think about that, the only reason why, in my point of view, the Federal Reserve chairman said that there is a possibility to have another hike, it's because he wants to anchor the interest rates. If he says, you know what, I'm not hiking anymore, and I think inflation now is finally going down, they're going to slash the interest rates, and maybe that would compromise the monetary policy. But I think at the end of the day, what's likely to happen is no more hikes this year, and likely to start having cuts for Q1 next year. But rather than, when I'm doing asset allocation for clients or for managing some funds, I'm not trying to predict exactly the month, I'm trying to see the trend. It is highly likely for the next 24 months that interest rates are going to be lower than it is today. So knowing that already, why we're not considering taking some investment grade long duration, for example? Knowing that already, why you're not considering buying some stocks at these levels that going down? And finally, I suspect that when you look into the expectations of the S&P going forward, and I hope you guys remember me, it's highly likely in our point of view that all of the strategies going forward, they're going to upgrade the S&P expectations. Based on what? that inflation is going down, because interest rates is likely to go down, because the recession is going to be shallow, everything that you're hearing. And that's going to build the momentum for all of the other stocks that are not performing to start going up.
So interest rates, correlations between stocks and bonds. I'll try to keep it brief because there's a lot of comments you just shared that I agree with. But if you think of stock-bond correlations over a full sample set, so across time, most would say this is the primary reason why a multi-asset portfolio is built with stocks and bonds. You own stocks for appreciation potential. You own bonds because they're not stocks. They're there to not generate a lot of return, but they're for diversification benefits, maybe some income purposes. But that's over the full sample set. If we look at shortened time periods where we have inflationary environments, stock-bond correlations are positive. Positive 0.2, 0.3, 0.4, so they move in the same direction. Not with necessarily the same magnitude, but usually in the same direction. And that's what we had experienced over the last year. Stock-bond correlations went from 0 to negative 0.1, 0.2 over the last decade to being positive. And that's why we had last year being a very unique environment where the S&P was down and the US ag or treasury bonds were also down. In the 100 years of market history in the US, that's only happened about 3 times where both stocks and bonds generated negative return. And very rarely, if ever, do you have 2 consecutive years of negative stock and bond returns. So perhaps, to your point, duration starts to work again. I think if you're looking at the environment in the United States where we've gone from 9% inflation to 4%, it's going to be much more challenging to go from 4% to 2% inflation. That's not to say that it won't necessarily get there over the next few years, but to do it in the next 6, 12 months, not likely. And I think the Fed's okay with that. They want to anchor at long-term inflation expectations around the 2% target. And if they can see with some sort of certainty, maybe some visibility that we can get to some around 2% inflation over the next several years, they would be okay with that. But now they need to be very careful. They don't want to message that too aggressively and have the market start to jump ahead of that and say, well, there it is, peak inflation, peak rates, and now the financial markets start to rally. Because if you do that, that could potentially provide ammunition, right, for inflation to then start to come back up again. And so I think the Fed's being very heavy-handed in its messaging, almost threatening to raise rates, but not necessarily looking to actually raise rates. Now, I don't have a crystal ball. I'm not privy to those discussions. But it does seem like we are at sort of peak inflation, peak rates in the United States. I could potentially see 1 more interest rate hikes, but I don't see several interest rate hikes. So longer-term theme, right? Peak tightening, eventually easing over the coming year. Maybe somewhere along the way we have a recession, but over the longer term, what we know is the cycles tend to be very long in terms of upside potential. So positioning accordingly and looking out with the long term in mind is more important today than trying to be very, very accurate and fine-tuning exactly what month inflation peaks and what month is the interest rates hiking cycle over.
So we are seeing a relevant dollar depreciation. What are your views on US dollar and what are the related investment implications? And what about other regions?
US dollar. Who believes that let's assume here for a second, $1 going up or down for the current level. So real now it's 4.7. Who believes it can go to 3.7? Nobody. Who believes it could go to who believes it could go to 5.7? All right. So that's the thing about dollar. And this is a saying and a joke that everybody says. And I'm an economist, so I can say that. God created the currencies just to humiliate the economy because we just make that wrong. That's the truth, right? Having said that, I'm going to make a prediction, not for how much is going to be the dollar on December 31st at 4 p.m. to do the P-tax. Forget about it. Nobody knows. And I think it's funny when I see some economists putting like 5.11 or 4.76, right? It's very precise. It's very hard to predict. So honestly, I have no idea where the dollar is going to be at the end of the month. But I'm going to do another non-consensus call here, and I hope that adds value to you. But I'm going to look for the next 5, 10, 15, and 20 years. Without looking to the currency, let's just take a look at 2 countries. Let's say country A and country B. For a country A that has more productivity than country B, it's likely that the currency of country A, higher productivity, will be stronger than the one that has less productivity, right? We suspect for the next 5, 10, 15, 20, that the US economy, on average, I'm talking more about real here, and then I'm going to talk about the other currencies. We suspect that it's going to be higher productivity in the US compared to Brazil. Now, that's only one thing, and what would be the trigger to make sure that's going to be the case? We suspect that the onshoring that's going to happen, I think people already discussed that here. The United States, they said, you know what? We depend too much on China. And by the way, that's the only subject between the Republicans and the Democrats that they agree with. It's China. Regardless they're right or left, China is something that they said, look, we cannot depend as much. I know it's going to be more expensive to build here, but let's do it. But wait, that's against the productivity. Wait a minute. Imagine, for example, a factory that was built in China back in the 70s, 80s, 2000, and now it's going to be built again in the United States. How much productivity and technology that will come with? And we think that's going to happen, especially in the AI, all of these trends that's happening. Productivity in the US will be strong. That's number one. The second thing is inflation. And I remember in Brazil, everybody was very proud, and including myself, that Brazil had a lower inflation last year than the United States, which was super cool. Well, 6 months later, guess what? Inflation in the United States is already lower than in Brazil. Now, country A and country B, a country that has higher inflation tends to have a more devaluation of its currency. I think that's intuitive, right? And we suspect that over time, the next 5, 10, 15, 20 years, the inflation in the US, on average, is going to be lower than inflation in Brazil. So that's 2-0 for the dollar already. And then we have the third, not going to mention much, but it's political stability. We have a country that has less political stability, the currency will be more, it's going to be weaker, right, than a country that have a more strong political stability. No comments, I think overall, going forward, the United States will be a little more predictable, just because we have at least two parties, right? Having 50, it's already too much. 3-0 for the dollar. And then I will conclude that with two other measures and get back to 2011, more or less. It was a moment that the real was super strong, 150, 160. And I remember, I was getting married at that time, and then all my family went to Orlando. I didn't spend much. It was great. What was happening at that time when the real was super strong? Number one, we had at that point in time a lot of the quantitative easing. We had negative interest rates across the board, and we had interest rates in Brazil on a relative basis way higher. And then everybody was putting money. So that's one reason. Second, at that point in time, China was growing double digits, and they were buying a lot of commodities, and prices was very good. Brazil, they export a lot of commodities, getting a lot of dollars here. Back then, that also helped the dollar, that helped the real. And third, overall, the Brazilian market was positive, somehow with some optimism. Now, let's fast forward to what's happening now. Central bank, 3 times more money than back in 2011. We're at a 470. Interest rates in Brazil, 13.75 compared to 4 or 5%. Dollar didn't change much. After the war that happened in Ukraine and Russia, commodities went up significantly after the COVID, super high, didn't change much. Now going forward, if I understood what I heard here this morning, it's highly likely that interest rate is going down here in Brazil. It is likely that the interest rates, the neutral, what they call interest rates, is more towards 4. The central bank, it's already ending all of these programs. They're not issuing more money. So it's a reverse of all of that. And China is not going to grow 10% again. Do you really think the real is going to go down that much? Over time. Maybe in the short term, the gringos, they'll say, wow, that's super cheap in Brazil. The carry trade is good. Yes, they would come in the short term. But going forward, I think what's going to happen to real, it's not they're going to have, a depreciation. It's going to be a super depreciation over time. Because this is what's happening since day one of the real. They only lost value because of everything that I said. And then I was checking the focus here in Brazil, the central bank gets together the expectations. I'm not seeing a massive change of expectations on the trade balances. I'm not seeing a massive change on for investors. So, oh, it's all-time high. But for this thing to go down, it should be way higher than it is today. So all to say that over time, we have this view that the dollar is going to be stronger. And then I can keep going here about the other currencies. So do not try, on an asset allocation basis, this is what we try to sell to our clients is, do not try to predict the currency to make an asset allocation. Because there's only one thing that's going to happen. You're going to be wrong. Try to see, the opportunities. And I'll ask you the last question here, for example. Does anybody have any idea of how much was the performance of Netflix, I'm picking one here, since May 2007, and why May 2007? Because it was the peak before the the 2008 crisis, until today. And I'm picking Netflix here, just because for several times, and I was living, I've been in the US for a while, and Netflix, actually, the business model at some point in time was they're going to deliver the CDs for you. And everybody said, that's crazy. They're going to steal the CDs. It's going to break. How are we going to manage that? And then they went up significantly. And then they said, you know what? I'm out of CDs. I'm going to do only streaming. Streaming, what is that? There's no TV that's going to connect into the streaming business. There's not even internet as fast to do it. And they did. And then they said, you know what? I'm not using more Hollywood movies. I'm doing the movies myself. And I'm going to spend $1 billion per year to make movies. Say, what? Are these guys out of crazy? And why I'm telling you this? Because I'm telling you all of the narrative that was negative and made sense at some point in time. Do you have any idea how much was the stock of Netflix since then? I'll tell you. And I remember when I was doing this exercise, I really thought that my spreadsheet was wrong. That was 10,000%. Of course, I'm not saying here that, when we invest overseas, we're going to find only this type of stocks. But I would do that with currency at 2, at 3, at 4, at 5, at 6, at 7, at 8, at 9, at 10, at 12, and I'll keep doing it. And now that going forward, we're seeing so much opportunities out there, cybersecurity, 5G, cloud computing. The biggest blockbusters of all time is coming from the drug that's going to control weight. Have you ever heard of Ozempic? I'm sure you can hear that, right? So it's coming now. Also, the artificial intelligence, there's so much opportunities out there that's going to be more dollarized, that thinking that the dollar is going to be weak, I think is going to be one of the silliest mistakes, and you're going to say, I wish I could know it again. Netflix are getting built. Apples again are getting built. Amazons are getting built. And this is just the beginning for the dollar, I think.
So views on a dollar. I'm going to try to answer on more of a short-term view. I think the dollar over the short term, if we're in a recession, it clearly becomes the risk-off trade. It becomes the safety trade, so a dollar catches a little bit of a bid and helps support your portfolios if you have more US dollar-denominated assets. If we don't have a recession, or we get past the recession, we are at peak inflation in the United States. More than likely, over the coming year, we will have a gradual move downwards in not just inflation, but also interest rates. And what that means is it signals for those global currency investors the differential between US rates and a basket of other currencies starts to narrow. So over the very short term, I could see the dollar moving in the current pattern of continued weakness. Now, albeit it's to be rather modest. I think there's a number of important points you just brought up that over the long term, if you're thinking about where the global companies are that are going to compound, astronomical levels of earnings growth and revenue growth through perhaps, unlocking AI technology, some of those companies are in the United States. Now, a lot of the valuations are quite high, and it certainly, perhaps accounts for a lot of the positivity. But it's hard to make a real strong case that the dollar will decline over the very, very long term. I think in the short term, though, where you have peak interest rates here in the United States, and you have other central banks across the globe in Europe who are still looking to raise interest rates to try and combat inflation, you're going to have that differential between declining expectations and interest rates in the United States, increasing inflation expectations in certain parts of the countries outside the United States, perhaps even in Japan. You're going to have some dollar weakness in the short term.
Okay, now let's talk a little bit about China. So China has a modest growth target of 5%. How does this impact global growth?
Right. I'll try to contextualize again on the portfolio. The question would be, should I purchase China? And if yes, how much, right? I think yes, over time you should have. And it depends, your risk tolerance, depends on your expectations. But yes, especially after hearing the guys talking here at, I think it was 10 a.m., I think was very well done. Of course, if China slows, China was used to purchase a lot of things from everybody. And when they slow, they purchase less. As a consequence, the other countries are doing differently. And that's one side of the equation because China actually changed its business model. Before they were producing things for the world and selling. Now it's more about the internal, right? The consumption. What I think, that's likely to happen is, and I have zero expertise in China. Everything that I'm saying here is based on our team that is based there. And we do have approximately, $25 billion managed by our Chinese team. What they think is, in the short term, yes, it's going to be a transition. In the short term, it's likely to still underperform. However, there are several triggers to start performing. And one of them is, what's going to be the next stimulus from the Chinese government, which is likely to be more in the tax cut, not in the infrastructure, and that should boost consumption, and that's more of the overweight that they have that. And remember, China, guys, when you think about the biggest companies that they have, China does not have Google there, but they have their own Google. China doesn't have they don't have the Uber, but they have their own Uber. Imagine, for example, the investments. Imagine I'm going to pitch for you here now a happy or of the this type of delivery in China. Imagine 1 billion people asking for food delivery for the next 10 years. Would you invest on it? Of course, it depends on the price. But what if I tell you the valuation is 30% discounted based on the average market? And what if I tell you that this company there's very limited leverage and have access to funding worldwide? Yes, and then you're going to tell me, well, but the government can do X, Y, Z, and that's true. I don't know what they could do, but there's so much opportunities there that in the short term, that's important to pay attention. So likely that's going to be bad for the global economy in the short term, but I think at the same time, this onshoring, these other countries developing its own manufacturing, that should balance somehow. So in other words, answering the question, we're not expecting the slowdown of the Chinese economy to affect the world economy into a recession or something like that.
So a slowdown in the Chinese economy is going to have certain impacts. Certainly Brazil would be impacted from commodities-related exposures. If you think of China's growth over the last couple of decades, heavy manufacturing-led from global build-out of the global supply chains, but then also internally a build-out of domestic infrastructure and a lot of focus on the property development section of the economy. But those are all pivoting. The Chinese government understands that there is a very high leverage internally within China, both at the overall corporate level as well as the consumer level, and so they're looking to transition the economy away from the boom and bust cycles around infrastructure-led investments to maybe more of a stable consumer-driven one. Now, that transition is not going to be even, and it's not going to be able to be done without having some dramatic impacts. And so what we're seeing with the current slowdown in the Chinese economy is that they are providing stimulus, but it's a lot less than what global investors had hoped for or wanted. They wanted to see more of the levers being pulled of $1 billion spending for new roads and bridges or for buildings. And what the government is doing is essentially trying to ease lending standards and allowing for lower reserve requirements. So perhaps using the banking sector as a way to try and provide some small bits of stimulus. Over time, the Chinese economy will slow from 6% GDP to 5% is the new target. It'll eventually fall to 4% and 3% over time. But you're still talking about 1 billion citizens and a tremendous amount of consumer spending potential. So I do agree. It's ideas like food delivery services, taxi cabs, right? Their own versions of an Amazon or Mercado Libre that's in China. Those are the companies that are going to provide perhaps the engine of growth going forward. Now, that being said, there's a little bit of concerns from the government, from central government, that a lot of these tech platform companies already have too much consolidated power. They are one of the largest sources of employment in China. And so the government put forth a lot of regulation over the last couple of years to try and crimp some of the powers that the Jack Ma's of the world can have. So we still see an opportunity in China, but perhaps going down cap into local companies like hotel operators, opticians and eyewear companies, HVAC manufacturers, breweries in China. If I were to bet on one particular region that has 1 billion citizens that have ample spending capacity over the coming decade, and to try and take advantage of it, and to also stay away from some of the regulatory crosshairs, I would look to invest in local Chinese companies that are maybe a little bit more small cap or mid cap, not necessarily the big tech platform companies that have a lot more upside potential, but also could have continued regulatory pressure from the central government.
So do you think the concerns about deglobalization are overblown?
I think so, because that's the way of seeing it. I remember seeing a post on LinkedIn about the ability of students to use ChatGPT. And then, of course, the professor said, of course not, right? And then they were showing other pictures when the HP 12C, which I'm sure several of you guys use, and the professors of university said, of course not, you shouldn't use. And some of you are old enough also to remember that when internet was becoming available into the office, a lot of companies said, no, of course not. We're going to only serve from the internet. Mm-hmm. And that's, I think, I'm using this just to make a point of globalization. Well, to put in context, what was happening is, if you go back in time, to understand really what happened to the globalization, that was our understanding. We saw, the war back in the Vietnam, and then a lot of unemployment happened in the United States. And at that point in time, they were building a culture of the hippies, like, it's cool to fail, in the sense of trying to become an entrepreneur. And that was really building up, and several people were doing it, and then they starting to have the foundation of the Silicon Valley back then. And then, of course, several countries went well, others not. And then we started having the problems of inflation in the 80s with the oil shock and et cetera. And then they said, you know what? Is there any place that we can produce that's going to be cheaper, and then we don't have more of these shocks? And China was the place. And pretty much said, well, let's just send everything to China. They produce that, and we import it back in a very low prices. And that was very important because China was exporting deflation to the world. So until then, China is not bothering, China is helping, globalization is good. By the time that China is becoming more relevant in the sense of getting wealth and putting more, the per capita GDP starts increasing significantly, and then they could invest more in technology. And then they said, I don't want to just build, bad toys, I want to do technology, I want to do other stuff. Then globalization became a problem, right? So this is depending how you look, if it's the problem or not, depending on where you are. What we think is the onshoring is a reality because this is a national security story now. I mean, if you're doing evaluation of a company, and then you see that there's one big client purchasing from this company, you should discount that. What happens if these guys stop making the payments, or they just go to another client? That's a huge risk. So that needs to happen because the financial market is speaking here. I'd rather be in an environment where the supply chain disruption is going to be lower because I have less globalization. In other words, I can produce more internally. Then all of this, and suddenly a government goes crazy, a pandemic breaks out, something happens in a war, and you are a hostage of the situation. So I think it's overblown in that sense, yeah.
So I agree that deglobalization or the threats of deglobalization are a bit overblown. If you were to look at the supply chain and just map out where all the different materials come from, where the intermediary products are, a lot of roads lead to China, and then from China back to other countries for sort of final assembly. In order to sort of take that apart and to try and invest the capital to recreate that would just be, I think, a long endeavor that no company individually, nor perhaps country, has the wherewithal to actually do. So there is a threat of some manufacturing leaving China, going to perhaps countries in Southeast Asia, maybe the immediate beneficiary, as well as India. Some in the United States, what we call nearshoring, reshoring, some small bits of manufacturing coming back to the United States. But To actually disengage from China is not something that I think anyone in the United States actually wants to happen. If we were to try and do that, it'd be hyperinflationary in the near term and ultimately be detrimental to corporate profits. Now, we talk about sort of supply chains and where those things are domiciled and how those things have been done over the last couple of decades, but what's often lost in the discussion on deglobalization is the actual skill set involved in actually manufacturing products. We often think of commodities as just being sort of cheap, right? Just something anyone could produce very quickly, very, very small margins. But in actuality, there's a lot of technology that goes into it. There is a documentary on Netflix, I don't know if it's still there, called American Manufacturing. Has anyone seen that? I see a couple of hands. It was quite interesting to me. I knew nothing about it. I don't like manufacturing as a documentary from a topic standpoint to watch, but one day it was on my Netflix streams, so I decided to watch it. And it had to do with a bankrupt auto manufacturing plant in the United States that was taken over by a Chinese company. The Chinese company had about 80% market share of global automotive glass. So anything that's glass related that's in your car is coming from this company. And what they decided to do was take over this bankrupt manufacturing plant in the United States, bring over all these Chinese engineers and technology leaders to try and recreate what's being done in China in the United States. And about halfway through the documentary, you see the amounts of money being spent in retraining, and then you see the line starting to run for this automotive glass, and then you see about 10 minutes of glass breaking, right? Retooling the machines, more breaks. Then employees in the United States saying, you know what, I'm working too hard. I want to unionize. I want better benefits. I want higher wages. And then the Chinese saying, well, we can't do that. We're running at very thin margins. We're going to actually sell this plant and get away and sort of close this investment if you're going to unionize. And you see more scenes of glass breaking. So the big takeaway for me was what I thought was a very sort of simple skill set, something that doesn't require a lot of effort, was actually something much more involved. And I think that is just one sort of simple example of if we were to try to reinvent, all the ball bearings, all the different products that go into a final assembled good, it would be nearly impossible to do that in the United States. And so the threats of deglobalization are there. We'll probably continue to talk about it for maybe the remainder of our lifetimes and our careers. But in actuality, it's probably just a small incremental change relative to how business has been done in the past.
So do you believe the role of multi-asset portfolio has expired? And if not, what role do they play now?
No way, absolutely not. I mean, because when we're talking about China or United States, who's going to be the next? Guys, we can have both. You don't need to have one or the other. And I think a multi-asset portfolio is exactly this. And sometimes it makes sense to have more fixed income, like now. Sometimes it makes sense to have more equity. So a multi-asset portfolio, it's here to stay. And let me ask you a question here, for example. Who believe having investments overseas is important? I think almost everybody. Now, who have investments overseas here? All right, that's great. And I think that's key because 98% of the opportunities are out of Brazil. The Brazilian GDP is approximately 2% of the global GDP. The Brazilian financial market is 1% of the global financial markets. You want to have 100% here? You should have more overseas because that's the opportunity. I'll tell you a story. I was doing a road show here right now, and then I was talking to a big developer in the south of Brazil. And then we were talking, we should increase our exposure offshore. I think there are great opportunities, valuation attractive, blah, blah, blah. And then he said, well, the problem is, my business is more in the real estate business, so I don't have enough cash to send. So I understand. Are you planning to sell at some point? Can we do something to help you with that? So no, the problem is, for me to have, because he has a big bank, land bank, a lot of land. And then he said, the problem is, if I want to do the development of this land, and then I can sell and cash it out, by the time that they get the approvals of the government, and this was close to the beach, it's approximately 7 years. What I think the bottom line was, imagine now we are here, we can decide, we have all the power in the world to put all our money in Brazil. You're not going to move. It's just too hard. And then if you have in the financial markets, for example, just for the stocks that are trading, between Apple and Microsoft, it's all the stocks in Brazil. Or the cash that is available in Apple, you can purchase almost all companies here. So why? I mean, we're going to start, thinking that having a multi-portfolio, that because of last year was bad, it's dead. Quite the opposite. And I think about the opportunities that is arising, and we're going to stress that out again. Imagine this situation here. Imagine that I'm the Rockefeller now, Rockefeller family. And imagine I'm going to pitch you guys a very good business opportunity. And say, hey guys, there is this oil, super dark, in the middle of the ocean, that is extremely expensive to take it off. We call this oil. And then we're going to use a lot of money to take it to put in cars that nobody has money to use. Want to do that? Oh, but there's no distribution. Nobody has money to it. There is not infrastructure for the cars to go. And look what it is in the interest now. And then, the EV, the electric vehicle, right? No, in Brazil, when I ask the people, there is no infrastructure, Who is going to wait 20 minutes or 30 hours for this thing to recharge? And then if I'm traveling and I'm going to stuck home, and then what am I going to do? And then last year, the biggest sale of a car was a Tesla. This is happening. And now the alternative energies. Oh no, solar is not as efficient as the oil. There is a lobbying. There's a lot of this. This is happening. Or the wind ones, it's happening. On all of this technology that is being, guys, when I hear, for example, there is a bubble in artificial intelligence, which may have, we're talking about a tool that maybe companies were not even created to be. Remember that that Facebook was like back in 2010. It was yesterday that was created. This is a massive opportunities for a multi-asset portfolio to get involved. And of course, your challenge here is to hire the managers who believe they can deliver that. And I think BTG has a great platform to find these managers, because this is going to transform, because things are changing as well. Imagine this. I remember one of the best investments here in Brazil was the following. You have a land, and then you rent that for a bank agent. So they pay you for 15 years, adjusted by GPM, and that was a beautiful thing, right? Suddenly, all the banks are going online now, and then, depending where you have your asset, you cannot build a building, you cannot do a house. Eventually, it's going to be a bakery there. And I'm not joking. I mean, it's happening. It's happening. So something that was super safe became extremely risky. How can you diversify? And all of these things that I'm telling you here, there's not enough liquidity, unfortunately, yet in Brazil. I think it's improving. I think it's going to keep improving. But how are we going to invest, in India? How are we going to invest in some countries in Europe? How are we going to invest in some part of the United States, in some of the other sectors? I was joking about the biggest blockbusters of all time that's about to happen in the United States or globally, which is the weight control. I mean, again, whoever tried to lose weight here? Everybody. And did that work? Usually not, right? On average. Now this drug is coming, and everybody could use, and it's finally working. And that's a big problem of the obesity here in the world. How can we invest on that? How we can invest not only who is making the drug, but on the suppliers. Who's making the transportation? Who's making the storage? Who's making the marketing? Who's financing that? All of the supply chain of these stories, you can only play in a multi-portfolio, and also in fixed income. Right now, we have an opportunity of the highest levels of yields over the last 15 years. You didn't have this opportunity 15 years ago, and you're telling me about the price of the dollar. Come on, what else you want? You have the biggest opportunity of the last 15 years, and it's highly likely that this thing is going to go down significantly. And only in a multi-portfolio you can capture that. And I mean, and usually people who are, because you're seeing my passion, and I put a lot of energy on these things, because sometimes it sounds silly, a person that has a lot of optimism, right? Because the pessimist is the person that is more risk aware. He may say, no, he's not paying attention on risks, of course. But usually the people who win are the optimism ones. And we believe that's one of the best opportunities that you had over the last 20 years, which could be the average of the career of the people here. So a multi-asset portfolio will help you navigate into that, and then you can do the hedges, you can do some tailor adjustments, but over time, and I'll give you the last data on the asset allocation, right? Because I like to say when I'm coming to Brazil, the biggest competitor that we have is the CDI, is the local interest rate. I mean, 13.75%, why on earth are you going to send money abroad, right? I did the math. And again, I'm going back to May 2007 until May 2023. On average, 9.7%. Amazing. Super good. In dollar terms, 3. All right, not that good. What about the dollar? How was inflation in that time frame? Approximately 7.5%. Dollar, 8.7. So dollar already beat the inflation. And then I'm going to ask you, let's assume for a second the terminal rate in Brazil is going to be 9. Right? And when you think of investing overseas in a multi-portfolio, you're not buying treasuries. You can buy treasuries, but you're going to have opportunities to invest in dollar plus 7, 8, a high yield today is paying 9, even 10%. Do you want to be only in reais? And this opportunity, I'm sure, you're going to see 15 years from now, we're going to say, damn it, I didn't catch that. So think of this in a strategic, and then, of course, the weights of how much you have, and maybe if you guys want to discuss on a tailored portfolio, finishing here, I'll be happy to discuss. But I try to avoid to say I'm 60% in equities or 40% in fixed income, because it really depends on your risk profile, right? If you tell me, look, if I make 5% and my investment horizon is 1 year, just buy treasuries, and it's fine. But over time, let's assume 25% in S&P, I'm not doing any stock picking, 25% in NASDAQ, 25% in high yield, 25% investment grade, just purchasing the ETFs and index. Over the last 16 years, you were 8% up on average in dollar terms. In real terms, 15% because of the valuation, better than the CDI. So yes, you can make money out of this. Don't think, currency is important, it's one element, but the opportunities that it's having now, I think this is really what's going to drive performance going forward.
Can you repeat the question?
So, do you believe the role of multi-asset portfolio expired? And if not, what role do they play now?
So I don't believe that the role of the multi-asset portfolio is expired, and mostly because, how many of you here don't believe in diversification? Anyone wants to raise their hand and say, I don't believe in diversification? I just want to invest in one thing? No one believes that. And why that is because what we know is there's always been investment opportunities, but with every opportunity is a lot of change and enthusiasm around that opportunity, and sometimes the actuality doesn't meet the expectations, and then you have huge losses. And so what we know is that over time, cycles come and go, whether that's US versus areas outside the United States from a regional perspective, certainly related to that currency exposures, whether that's growth styles or value styles of investing. Within fixed income, whether you own government bonds or you take more risk with corporate debt, these cycles all come and go. And if you have the wherewithal to understand the macro environment globally and then identify which specific investments can do well, then you don't need to diversify. You yourself are making those choices. But in actuality, even professional investors have a very hard time identifying these things accurately. And so the benefits of diversification ultimately means that a multi-asset portfolio is still relevant today. Diversifying your bets globally, both in equities and fixed income from a starting point, we believe is the appropriate course of action. Now from there, you can take a look at the current market environment and making sort of accurate, or trying to make some sort of accurate adjustments to the portfolio around where you think areas are more opportunistic. The way we manage portfolios at Rowe Price from a multi-asset standpoint is to have a strategic allocation diversified across the globe, and then making small shifts on a month-to-month basis, 1-2% in one direction, maybe buying more stocks, maybe buying more US, or at the current time actually selling some US and getting some exposure to areas like Japan. Those are things that we believe over time can be more additive and can allow for you to generate still a reasonably good rate of return, but also tamp down some of the volatility. Because what we know with the primary benefit of multi-asset portfolios is that it allows investors to stay invested. Investments is not a timing game, but it's more about time in the markets. What we know is the longer you invest your monies and hold on to that investments, the more likelihood of success, whether your goals are retirement or to save up for a purchase of a home or whatever financial needs that you have, the longer you're able to invest, the more likely you're able to achieve that goal. The timing, going in and out of various parts of the markets, that's what everyone wants to focus in on. That's where the excitement is over, right? Like who's gonna call the next NVIDIA stock or who's gonna call the next Mercado Libre stock? That's what we all wanna know. And in reality, for every guess that's accurate, you probably have 3 or 4 that's wrong. So from us, within the multi-asset team that I'm a part of, having a diversified portfolio and making small measured changes to that portfolio over time, if you can identify major themes, some of which we highlighted today, right? Sort of peaking inflation globally and moderating inflation over time, perhaps some softness in the US dollar over the short term. Identifying those themes and making some appropriate tactical allocation decisions is, we believe, the best course of action that can ultimately result in better results for your portfolios.
Okay, so what is your worst fear from current market environment, and how would you build a strong portfolio?
I think, every time that you're building an investment thesis, the biggest risk is if, what something goes wrong. And I think the biggest risk right now, it is another central bank mistake. If you recall, the central banks took forever to hike rates. What if they took forever to cut rates? Take forever to cut rates. I think that's one risk. If that's the case, what if, rather than have a shallow recession, what if it goes a deep and long recession? That's definitely another risk, and that would change the whole environment of a portfolio. So in a portfolio like this one, you should overweight treasuries, of course, because of the flight to quality that might happen if that's the case. So you should have more value stories because they don't have a lot of finance risking on the very high interest rates because they have lower leverage. You should focus more on investment grade as well, exactly for the same reason compared to the high yield. That would be a more bulletproof portfolio in case you are concerned about the current macro consensus. Now, a strong portfolio also should have some bets that have a low probability of happening with high impact. Right? And I think that's something related to alternatives as well. You should have some alternatives, especially in the private equity, in the secondaries, some private debt, mezzanine debt, things like that, that eventually could help you also generate, doing some of these bets in the private equity especially, that could, have a significant impact on the portfolio. So also, depending on the volatility, I like the idea of purchasing always some puts when it's not expensive. The VIX now, every time that is below 15, it's something that you should put in your screen to consider buying puts, because that's, is something that, regardless of your market view, it can always go wrong. I remember, for example, talking to clients by the time that we were having the possibility of a Russian invading Ukraine. And to be honest, I said, it's unlikely to happen. 2022, that's going to happen? I don't think so. I remember several times during 2008 telling to clients, hey, look, I think this is very specific to real estate market. It's only there, and then went to the whole economy. I remember in the COVID saying, look, this is just a virus. This is not going to spread. Do you really think everybody's going to be home? Right? So things can go wrong, and you should have these protections and some of this low probability with high impact in your portfolio always.
So what could go wrong? I think global investors were very, very lucky over the last year. So Russia-Ukraine you brought up. Think about what happened in Russia-Ukraine. There's a war. There's concerns that Europe's going to go into a deep recession. Why is that? Because there's going to be potentially a cold winter, and there's going to be a massive demand for fuel, and costs of that fuel will go up, leading to hyperinflation. And what we had was a rather warm winter and record levels of storage of fuel. So we're able to dodge one potential risk. We had the China reopening. China went from zero COVID policy to the grand reopening and sort of a chaotic, let's just open up the economy, allow consumers to spend. And what we saw was an initial positive impulse that has since started to fizzle. More recently, economic data in China is showing a slowdown relative to expectations, and so the central government there is intervening with some modest forms of stimulus. So a slower China, or a slower path to recovery in China, is also putting a downward pressure in commodity prices and as a result, inflation. Now, what happens in the back half of this year? Perhaps the Russia-Ukraine war still continues, and the weather patterns go from La Nina to El Nino, and now we have a severe cold winter. And then we have a massive demand and potentially higher inflationary impulses in Europe. What if the China sort of slower path to recovery today starts to reaccelerate by the back half of this year? Maybe it's stimulus, maybe it's consumers starting to feel a little bit more emboldened with their future spending. If we have a reacceleration in China, we could see an upward bias to commodity prices and as a result, inflation. So I think the biggest concern right now is we're living through an environment real time. It almost seems like Goldilocks. Inflation's high, but it's going downwards. Central banks are going to stop tightening. They're going to start easing. We have this AI boom here in the United States that's going to allow for companies like NVIDIA and Microsoft to do well and corporate profits to accelerate. Don't worry about margins being impacted. Well, that's the narrative today. What happens if inflation starts to reaccelerate and the central banks say, 5% is not high enough. Maybe it's 6, maybe 6.5. Who would have expected that? So potentially those sort of low probability events, but hedging against that could potentially work, right? Having some of those things within the portfolio. Now, there's a number of different ways to try and hedge a portfolio. Put options are one. They can be expensive at times. They currently are cheap. But within our portfolios, we actually use a number of different techniques to try and solve for tail risk hedging. We use things like options as one signal, but we also use long-dated treasuries as another, and sort of a flight to safety. And we do use alternatives as well within our portfolios. Things are not negatively correlated, but more or less sort of very lowly correlated to global equity markets and fixed income markets, and introduce a source of alpha that ultimately allows for some portfolio protection. So we think a basket approach to using options as well as other techniques to try and hedge against some of these sort of lower probability events, but that could potentially occur maybe in 6 to 12 months from now.
Perfect. So to end this panel, would you like to share a final message with the investors today?
I would send two. I had the opportunity in my academic career to do my master's with Jack Welch. And Jack Welch, for those who are younger here today, he was kind of the Steve Jobs of his area. Right? When he was talking, everybody was listening to him. And something that I never forget when he said, and he was using all of his books and etc., was change before you have to. So if your asset allocation today, it's almost 100% in Brazil, change before you have to. That would be my final message.
I thought you had 2 points.
On the second one, well, I mean, it's just the bottom line. Guys, interest rates is going down in the United States. Inflation is going to go down in the United States. Dollar's not going to lose for cryptos or, these currencies. Other currencies may be more relevant. The dollar's going to be safe. It's going to be strong. Everything's going to be fine. And remember the dollar smile theory. When everything goes wrong, the dollar gets strong for risk aversion. When, United States get weaker, the dollar loses a little value. We think that's where we are. And then interest rates is going to go down. All of this technology is going to happen. The dollar is going to go stronger again because of the opportunity. And as you said, it's not about timing the market. It's about time in the market. Don't be silly. Don't try to, try to understand what's going to happen next week. You're not going to make it. Go over time, go long term, and it's likely that we're going to overperform over time.
So this is a message I often give my family members. Usually when we gather for holidays, I'm the only one who works in the investment industry. So everyone corners me and asks me, like, hey, what's the next stock that's going to go up, right? Like, where should I put all my money? And they always want one idea. They don't believe in diversification. They just want the stock that goes from $1 to $100. But I always tell them the same two things, time in the market, not timing the market, right? So I believe in that. But I also believe that in order to be a successful investor, if you think about all the topics we discussed today, macroeconomics, right, inflation or no inflation, where are the central bank rates headed, where's the recession happening, what are currencies going to do, themes that, that could do well, do you hedge the portfolio or do you not hedge the portfolio? It's a lot of things to think about. And ultimately what you want to do as a successful investor is to find a partner who has the expertise from a global standpoint to find managers or tap into the research platform to find ideas that can ultimately be a part of your portfolio. What you don't want to do is, one, go alone, because there's too many things to think about. And again, there's, if you can do it, God bless you that you can do that and have that kind of that kind of skill set. Perhaps you should come work for T. Rowe Price. But in reality, what you want to do is find a trusted partner who has scoured the globe to find the managers who can help you with your portfolio, and lean on that partner, like BTG, to ultimately invest successfully and to keep your monies invested in the markets to ultimately to achieve that sort of financial goal that you had in mind. So that's my final message, right? Time in the market, but also partner with someone who can help you.
So thank you very much, Luis, Matthew. It was a pleasure to have you here with us today, sharing so many great insights. Thank you very much.